Here's a question most people never ask about the Great Depression. What if the crash wasn't the story? What if it was just the ending? Because by October 1929, most of the damage had already been done. Not in the market, in the years before it. In the boardrooms, the brokerage houses, and the bank lending desks where ordinary Americans were handed something they'd never had before: access to credit. And they did exactly what you'd expect. They used it. But here's what makes this more than just a history lesson. The people who built the most wealth in that era weren't the ones who rode the boom. They were the ones who understood what the boom actually was and positioned themselves accordingly before everyone else figured it out. The people who lost everything weren't reckless, necessarily. Many of them were simply the last to arrive at a party that had already been going on for a decade. This video is about the full arc of that story. We're going to walk through how the Federal Reserve was born and what it actually changed about the American financial system. We're going to look at how cheap credit fueled a decade of genuine prosperity and a speculative bubble at the same time. We're going to trace the crash, the bank runs, the institutional response, and the documented reality of who held wealth going in and who held it coming out. And then, because the pattern is the point, we're going to ask honestly whether any of this sounds like the world we're living in right now. Not to tell you what to think, to give you the framework to decide for yourself. To understand the crash of 1929, you have to start about 16 years before it. In 1913, Congress passed the Federal Reserve Act. The United States had just lived through the panic of 1907, a financial crisis that nearly brought down the entire banking system. The reason it didn't was not good policy or smart regulation. It was one man, J.P. Morgan, who personally convened the leading bankers of New York in his private library and strong-armed them into coordinating a bailout. It worked. But the entire episode made something uncomfortably clear. The financial stability of the United States should not depend on the availability, the health, or the goodwill of a single private citizen. When Morgan died in 1913, that clarity became urgency. The Federal Reserve was the answer. Its original mandate was relatively narrow. It would serve as a lender of last resort, a backstop for banks that ran short on cash during times of stress. It would issue a new form of currency, Federal Reserve notes, that could expand and contract more fluidly with the economy's needs. And it would provide something the old system chronically lacked: elasticity. The ability for the money supply to respond to the actual demands of a growing economy rather than being rigidly constrained by the availability of physical currency. Now, here's something worth being precise about, because this point gets muddled constantly. The creation of the Federal Reserve did not end or meaningfully break from the gold standard. The dollar remained defined in terms of gold. Federal Reserve notes were redeemable in lawful money. The Fed not only operated within the gold standard, it was legally charged with maintaining it and kept a required percentage of gold cover for the currency it issued. If you've ever heard someone say that the Fed's creation in 1913 was the moment America went off gold, that's not accurate. That story is more complicated, and it comes later. What the Fed did change, and this is genuinely significant, is the architecture of credit. Before the Fed, the money supply was highly inelastic. National banks could only issue notes in proportion to the government bonds they held. The system couldn't breathe. The Fed introduced a mechanism through which credit could flow more freely, expand more readily, and be directed more purposefully. That was a real structural change. And over the decade that followed, the financial system used that new flexibility extensively. Between 1921 and 1929, the U.S. money supply grew by roughly 62%. That number is worth sitting with. In 8 years, the total stock of money and credit in the American economy expanded by nearly 2/3. And critically, that growth wasn't primarily physical currency being printed. It was credit, bank loans, broker loans, installment financing. The expansion was happening at the level of lending, not printing, which made it feel stable, even virtuous. You weren't inflating the currency, you were just making it easier to borrow. That distinction would matter enormously when the reckoning came. Before the 1920s, the stock market was largely a game for the wealthy. Brokerage houses were not places that working-class Americans walked into. The idea of an ordinary factory worker or department store clerk having a stock portfolio was, for most of American history, simply not how things worked. Capital markets were for people who already had capital. The 1920s changed that, and the mechanism that changed it had a name: buying on margin. Here's how it worked in practice. You want to buy $100 worth of stock. Under the margin rules of the 1920s, you only needed to put down $10 of your own money. Your broker would lend you the other $90, using the stock you just bought as collateral. If the stock rose to $120, you'd made $20 on a $10 investment, a 200% return. The leverage was extraordinary, and it was available for the first time in American history to people of relatively modest means. By 1928, broker loans, the money lent to investors to buy stocks on margin, had reached $6 billion. That was nearly double what they had been just 3 years earlier. The feedback loop was already running. Rising prices encouraged more borrowing. More borrowing drove more buying. More buying pushed prices higher. Higher prices made the whole thing look rational. Irving Fisher, one of the most respected economists of the era, declared in October 1929, days before the crash, that stock prices had reached what looked like a permanently high plateau. It wasn't just stocks. Consumer credit was expanding simultaneously across the whole economy. Americans were buying automobiles, refrigerators, and radios on installment plans, new financial products that gave ordinary households access to purchasing power they hadn't previously had. For the first time in the country's history, middle-class Americans could participate in economic life the way wealthy Americans always had, by borrowing against their future income. This produced the Roaring '20s, and it's worth being honest about this. The prosperity was real. Not entirely, not evenly distributed, but genuinely real in important ways. Industrial production surged. New technologies created new industries from the ground up. The automobile sector alone reshaped the geography of American life. Unemployment was low. Wages grew. The economy was not a pure mirage, it had substance. But underneath the genuine growth, something structural was building that most participants couldn't see. The economy had become, in a meaningful sense, dependent on the continuation of credit expansion. The asset prices being quoted in the newspaper every morning were prices in a market fueled by borrowed money. And borrowed money has a feature that distinguishes it sharply from earned money. It has to be repaid. Now, here's the part of the story that economic historians have spent the most time examining, and where the wealth transfer framing that frames this video gets its most legitimate foundation. The people who got access to cheap credit first were not the people buying stocks on 10% margin in 1928. The first beneficiaries of the credit expansion were institutional, banks, established industrial firms, people who were already inside the financial system and understood how it worked. They borrowed cheaply, invested early, rode the appreciation, and in many cases, had both the information and the institutional capacity to assess when the market had become untethered from fundamentals. The people who arrived last were the ones for whom margin accounts were a new thing, who had watched the market go up year after year and concluded, reasonably enough, that they were missing an opportunity, who took on leverage to participate in a system they didn't fully understand at exactly the moment the system was most overextended and most vulnerable. This is not a conspiracy claim. There is no documented evidence of a coordinated effort by wealthy insiders to inflate the market, exit at the top, and leave retail investors holding the bag. The historical record is more complicated than that. Many prominent wealthy investors lost significant fortunes too. What the record does show is structural asymmetry, information asymmetry, leverage asymmetry, access asymmetry. The people who understood the system best, who had the longest financial runways, who could choose when to exit rather than being forced out by margin calls, those people navigated the crash differently than those who couldn't. Galbraith documented this dynamic extensively in The Great Crash, 1929. The academic literature on the period, from Eichengreen to Kindleberger, supports the structural read without requiring the conspiratorial one. The outcome was a transfer. The mechanism was structural, not orchestrated. By 1928, the Federal Reserve was watching the stock market with serious alarm. The boom had gone further than expected. Speculation, particularly the margin-driven broker loan-funded speculation that had become the dominant feature of financial markets, had reached a scale that was making policymakers genuinely uncomfortable. The Fed drew a distinction, publicly and in its internal deliberations, between productive credit, lending that financed real economic activity, and speculative credit, lending that was simply financing the purchase of financial assets at ever higher prices. It wanted to restrain the latter. So in the spring of 1928, the Fed began tightening. It raised its discount rate, it sold government securities to pull reserves out of the banking system. It tried to signal to banks that lending for stock speculation was not something it would continue to accommodate. The goal was to deflate the speculative excess without triggering a broader economic downturn. It did not succeed at that distinction. Milton Friedman and Anna Schwartz, in A Monetary History of the United States, the most influential work of monetary economics written in the 20th century, identified the Fed's tightening beginning in spring 1928 as the institution's first grave mistake of the Depression era. Their argument was that the macroeconomic environment didn't justify it. The economy was barely out of a mild recession. Commodity prices were already falling. There was no meaningful inflation threat. But the Fed tightened anyway, and in doing so, it began draining the credit that had been fueling asset prices for the better part of a decade. Ben Bernanke, when he was still a Federal Reserve governor in 2002, essentially acknowledged this directly in a speech honoring Friedman. "You're right, we did it. We're very sorry, but thanks to you, we won't do it again." What followed the tightening was a cascade that had the internal logic of a trap. When the market started falling in autumn 1929, investors who had borrowed to buy stocks received margin calls, demands from their brokers to put up more cash or liquidate their positions. Most couldn't put up more cash, so they sold. Their forced selling drove prices lower. Lower prices triggered more margin calls across the market. More margin calls forced more selling. The mechanism that had driven prices up for years, leveraged buying, worked with equal efficiency in reverse. The Dow fell nearly 90% from its September 1929 peak to its July 1932 bottom. That is not a typo. But here's the critical thing that's often misunderstood. The stock market crash alone did not create the Great Depression. The 1929 crash was severe, but by the autumn of 1930, the economic contraction, while serious, was not dramatically worse than previous downturns the country had absorbed. The panics of 1893, 1907, and 1920 had all produced sharp but recoverable contractions. What turned 1929 into something categorically different was what happened to the banking system. Americans, rationally, given what they were watching, began pulling their money out of banks. They had no reason to believe their deposits were safe. Banks had been lending aggressively into the boom. When asset values collapsed, bank balance sheets collapsed with them. And in 1929, there was no deposit insurance. If your bank failed, your savings were gone, permanently, not temporarily locked up, gone. So people ran, and the running made it worse. Banks that might have survived a normal downturn were pushed into failure by depositor panics. More than 1/3 of American banks failed in the years between 1929 and 1933. Approximately 9 million savings accounts were wiped out. The money supply contracted catastrophically by roughly 1/3 as the credit that had been created through the banking system was destroyed faster than the Fed could or would replace it. That contraction is what made the Depression great, not the crash itself, the institutional collapse that followed it. The FDIC, the Federal Deposit Insurance Corporation, was created in 1933 under the Banking Act, specifically to prevent this sequence from ever repeating. The logic is elegant. If depositors know their money is insured up to a set limit, they have no rational reason to run. The panic that turns a bank's temporary illiquidity into a permanent failure gets short-circuited before it starts. Today, the FDIC insures deposits up to $250,000 per account. It's funded by premiums paid by member banks, not by taxpayers on an ongoing basis. It is a genuine structural improvement over the 1929 architecture, not a guarantee against all financial crises, but a specific solution to the specific catastrophe that made the Depression as deep as it was. Now let's look at what the data actually shows about wealth. where it was going into the Depression, and what happened to it coming out. Going into the crash, the top 1% of Americans owned over a third of all American assets. The credit-fueled boom of the 1920s had concentrated wealth significantly at the top. Middle-class households, meanwhile, had stretched their balance sheets into consumer credit, automobile payments, appliance installment plans, margin accounts. They were participating in prosperity, but they were doing it leveraged with limited cushion. When the crash came, the damage tracked exposure, and exposure tracked leverage. The people most exposed were the ones who had borrowed most recently at the highest prices with the least financial cushion underneath them. When margin calls came, they were forced sellers, not by choice, but by the mechanics of their debt. They sold at the worst possible prices into a falling market and locked in losses that wiped out years of gains in weeks. Meanwhile, the people with cash and no debt found themselves in the opposite position. J. Paul Getty operated by a principle he stated plainly: buy when everyone else is selling and hold until everyone else is buying. He bought oil assets during the Depression at prices that generated extraordinary wealth over the following decades. Alfred Lee Loomis and his partners similarly emerged from the crash with their capital intact, having exited the market before the peak and spent the Depression years acquiring assets at distressed prices. These are documented examples, not mythology. The broader wealth picture after the Depression reflected this dynamic. Progressive estate and income taxation introduced during the New Deal era eventually reduced extreme wealth concentration. But in the immediate aftermath of the crash, the people who had cash won, and the people who had debt lost. That's the documented pattern. To be precise about the framing, calling this a transfer is interpretively accurate, but requires the right caveats. There was no coordinated scheme. Many wealthy investors lost significant money too. The mechanism was structural, leverage and information asymmetry, not conspiracy. And the outcome was a redistribution of assets from those who had to sell to those who could buy. The transfer is real. The intentionality is contested. That distinction matters if you want to think clearly about it. So here's the question the title is actually asking. After 2008, the Federal Reserve cut interest rates to near zero and held them there for the better part of a decade. The stated purpose was to support recovery, to make borrowing cheap enough that businesses would invest, consumers would spend, and the economy would get back on its feet. That's a legitimate policy rationale, and it largely worked in terms of preventing a second Great Depression. But cheap credit, as the 1920s demonstrated, doesn't stay neatly inside the boundaries policymakers intend for it. It flows toward wherever returns are highest, and through the 2010s, the highest returns were in financial assets, stocks, real estate, private equity, and eventually cryptocurrency. Asset prices rose steadily for more than a decade, supported by a cost of capital that was, in historical terms, extraordinarily low. Then 2020 happened. Interest rates went back to zero, direct stimulus payments reached households, commission-free trading apps put brokerage accounts in everyone's pocket. Retail investing surged at a pace without historical precedent. Millions of new accounts, meme stocks, crypto speculation, and a broad cultural moment in which the stock market felt like something everyone was participating in and everyone was winning. Look at the structural pattern. An extended period of cheap credit, asset price inflation running well ahead of underlying economic fundamentals, a new wave of retail participants entering markets that were already highly valued, the democratization of access, this time through smartphone apps rather than 1920s brokerage storefronts, bringing in a new class of investors who were, structurally, the last to arrive. The parallels are real and they're worth taking seriously. Where the analogy holds most clearly is the mechanism. Cheap credit inflating asset prices, late retail participation, leverage concentrating risk among those who understood it least and had the least cushion to absorb losses. The 2021 retail investor who borrowed to buy crypto or bought meme stocks on margin at peak valuations occupied a structurally similar position to the 1928 margin buyer who arrived at the party a year before the crash. Where the analogy breaks down is the institutional architecture. The FDIC exists. The Federal Reserve has far more sophisticated tools and has demonstrated since 2008 a willingness to deploy them at scale to prevent cascading bank failures. Capital requirements from major financial institutions are substantially higher than they were in 1929. The regulatory framework built out of the New Deal and expanded after 2008 represents genuine structural improvement. These differences are not trivial. But here's what history actually teaches about institutional improvements. They reduce the severity of crises. They don't eliminate the underlying dynamic that generates them. So long as credit cycles exist, so long as periods of cheap, accessible borrowing inflate asset prices and draw in participants late, the structural pattern the 1920s demonstrated will reassert itself in some form. Better guardrails change the damage. They don't change the cycle. Where we are in that cycle right now is a genuine open question. Interest rates rose sharply from 2022 onward, and credit conditions tightened considerably from the ZIRP era. Whether that tightening produced a quiet correction or whether the full accounting is still ahead, that's not a question anyone can answer with confidence. What history offers is not predictions, it offers patterns, and the pattern here is consistent enough across enough cycles that it seems worth understanding. The Great Depression is usually taught as a story about a single catastrophic moment. Black Thursday, the ticker tape, the breadlines. A crash that came out of nowhere and devastated the country. But the crash didn't come out of nowhere. It came out of a decade of credit expansion that concentrated risk in the hands of the people who understood it least, who arrived latest, who had the least capacity to absorb the losses when the system corrected. The crash was just when the accounting came due. The real story is the decade before it. How credit was created and who got access to it first. How ordinary Americans participated in prosperity that was partially real and partially borrowed. How the structural asymmetries of the financial system, in information, in leverage, in staying power, shaped who built lasting wealth and who lost everything in a matter of weeks. Whether that story is rhyming right now is a question you're going to have to answer for yourself. The tools for that assessment are the same ones that would have helped someone in 1928. Understanding what's driving asset prices, understanding your own leverage and your own cushion, and being honest about whether you're participating in genuine value creation or in a credit-fueled feedback loop that's been running long enough to feel permanent. The 1920s felt like a new era right up until they didn't. If this kind of financial history is useful to you, subscribe. There's more where this came from.